What's going on, everybody? I hope you are all doing well. So in today's video, I thought I'd take you through a simplified version of an SMC strategy. So it's going to be very simple, easy to follow. And I'm also going to write out a little trading plan for you as well, which I have personally used for quite a long time now. It's been about 2 years since I've been using this, and I found it to be very profitable over the long term. So that part is already done for you guys. So if we actually start, and I'll just take you through a PowerPoint of the strategy itself before we get into the trading plan. And then later on, I'll take you through some examples as well, just to make it a lot more clear. So I've broken this down into 3 steps just to simplify in a very basic way. So step 1 is to simply identify the trend like you would really do on any strategy on the higher time frame. And then we are going to identify our higher time frame point of interest. And the 2 entry models that we're going to use for our point of interest is if price is clearly in a trending market on the higher time frame, and we are printing, for a bullish example, higher lows and higher highs, we want price to pull back into a discount of the current leg of the trend, meaning it has to pull back at least into past the 50% of the leg of the trend. So the leg being this low to this high. And then we want price to pull back into an imbalanced level of demand, which has liquidity above it. This can be in the form of inducement, equal lows, trend lines. Just identify where people are buying early and are likely to get liquidated. So we wait for price to tap into a higher time frame area of interest. The second area or type of area that we would look at is when price goes from printing higher lows and higher highs, just like here. And then we take out the most recent structure with an impulsive move down. And then we retrace into an area of supply, which caused the break of structure. And then we look for sells down, targeting whatever areas we want to target. So that would be step 1. Simply just to identify the trend and the higher time frame areas of interest. Step 2 then is our lower time frame entry model. And this is simply when price taps into our higher time frame area, like it already has done from the previous slide. We then wait for, on the lower time frame, for price to break structure in the opposite direction to the trend. So if price is higher time frame bullish and we are looking for buys, on the lower time frame, this is going to be looking like a downtrend. Because the higher time frame would be moving down at the time. So on the lower time frames, it's obviously going to be a downtrend, printing lower lows and lower highs. What we want to do is identify price breaking that structure. So as price comes into our area of interest, we want to see a break of the most recent lower high. We then want to see price leave behind an imbalanced level of demand or supply if we're looking at sales. We want to see liquidity generated above that area, and then we are simply going to set a limit on that imbalanced area of supply and demand. And don't worry, I will go through a few examples in a moment just to make that a little bit more clear. Step 3 then, simply identify our targets. So if you are very confident on the trade and very confident in your analysis of the overall higher time frame trend, we can simply target the trend highs and lows. And this gives a very big risk to reward since you're entering on the lower time frames and targeting a higher time frame area. Alternatively, we can simply target areas of liquidity or higher time frame supply and demand areas where price is likely to come to. And for this, we're going to use a minimum of a 1 to 3 risk to reward. If the trade, or if you can't get a 1 to 3 risk to reward, then I simply wouldn't take the trade. Simple as that. So if we go back now and look at the actual trading plan. So we've got our steps here. So we've got price comes into a higher time frame area. That's step 1. We then go to the lower time frames and wait for price to break structure, confirming that our area is likely to hold. We then identify an imbalanced area of supply and demand that caused the change of character. We then want to see some liquidity created above it, and we simply then set the limit on that area, entering with stop loss just below it. And we're going to target those trend highs and lows, or any areas that you think price may reverse from. For a higher time frame area, we require that it's a supply and demand area. We also require that it's imbalanced, and we also want to see that liquidity being generated above or below it. And for risk management, probably the most important part of any trading plan, this should probably be at the top, actually. A lot of people don't really place much emphasis on this part, but as I said, I would keep this simple. 1% risk per trade, no matter how you feel about the trade. If you're confident in it, if you're not confident in it, 1% risk. If you're on a losing streak, 1% risk. If you're on a winning streak, 1% risk, no change in the risk. The only time we're going to make break even is before high impact news, where price may cause you to be slipped on any positions. So these are events like FOMC, NFP, CPI, things of that nature, which may cause price to slip past your stop loss, because that would cause you to lose more than 1% on any given trade. And like I said before, minimum 1 to 3 risk to reward. Otherwise, we're not interested in the trade. So now if we go to the charts and actually look at a few examples. So this is one that occurred recently on GU. It was a very nice trade. So starting on the daily time frame then, first step was to identify the higher time frame trend, which in this case we can clearly see is bullish. And we have this daily break of structure just here. This right here is our higher low. This is the current high of the trend. So price is printing higher lows and higher highs, meaning it is in a current bullish trend. And therefore we are only looking for buys at this point in time. So as for our areas of interest then, we have this daily area of demand, and there is no imbalanced areas below it. So we were expecting this level to hold, but we were waiting again for that confirmation. And if we just change the color of this. So at this time, what we can see is that the lower time frame, in this case, the 1 hour, is bearish. We are printing lower lows and lower highs. We've had this bearish break of structure to the downside. So we want to see this high taken out, and that would give us our confirmation for the buys. So if we just wait and see what happens. There we go. So that is our change of character, confirming that the level we identified is going to hold. That is our change of character. And now what we want to see is a retracement into an area of demand which caused the change of character. And we also required that it was imbalanced, if you remember from the slides. So at this point in time, we have 2 areas of interest. We have this one, and we also have this one just below. All of the areas below that are already mitigated. As you can see, price was wicking up, came back down, wicked back in, and was just simply filling the imbalance. So this is efficient price action below, and we are not interested in any levels if price were to sell past these 2 areas of demand. So all we do now, like with the higher time frame strategy that we just did, where we identify higher time frame point of interest, lower time frame change of character, we simply do the same thing on the 15-minute and the lower time frames once again, since we are unsure about which area to enter from. If we were very confident in one of these 2 areas, then at this point, yes, we could just set the limit. However, in this case, there are 2 possible levels where price could react from. So we simply be patient and wait and see which one reacts. There we go. So we delete this one. This area here has had a nice reaction, and notice how we've had this further change of character here within this internal trend. So price printed a lower low, a lower high, a lower low, a lower high, a lower low. Price has now printed a higher high, breaking out of this structure, confirming that this little pullback here is over. And what we have also done is left behind this imbalanced area of demand, imbalance created here. And we've also started to generate some liquidity above it as well. So now we just simply set the limit, stops probably just below this wick. And then as for targets, we could target this imbalance on the 2 hour, or simply this area of liquidity. That would do. It was a 1 to 4, so above our 1 to 3 minimum. And then we simply wait for the trade to play out, remembering that we are not making this break even until it either hits stop loss or take profit, or a high impact news event comes out. In this case, it didn't, so we just held the trade. And there we go. It was a very nice example. So yeah, that was the first example. I'm just going to go through one more example now. If we go through gold, I know a lot of you guys like to trade gold, so this would be a good example. Okay, so if we go back, just to here. So at this point in time, gold was still technically bullish. We had this break of structure here. And we had also left behind this imbalanced area on the 4 hour. You can see this is an imbalanced level of 4 hour demand, created this imbalance here. And we had lots of liquidity being built above it, which is why this is what validated the area for us. And then as before, we rinse and repeat. We go to the lower time frames, and then we wait and see what happens and if we can get that lower time frame break of structure. So in this case, lower time frame is clearly bearish. We've had this bearish break of structure. If we go on the 5 minute, that's a lot clearer to see. We've had push up, retracement, causing that bearish break of structure. So now in order for us to get our confirmation, we need to see this area fell. And let's see if that happens. There we go. So we had the break of structure in the opposite direction to the trend. That is our change of character. We have also left behind this imbalance, and we also left behind this area of demand, which caused the change of character, created this imbalance, and we have also started to generate this liquidity in the form of inducement just above the area of demand. So at this point, we simply set the limit like this, stops just below. You could have it below this wick, or you could just have it below the area of demand, as if price comes below the demand, then we were wrong on the trade anyway. As for targets, we have this sort of mini area of supply, which could be your first target. And then second target would probably be, if we go to the higher time frames, this hourly level of supply up here. So for the sake of the video, we'll just target that. And let's see how it plays out. Extra compliments now, actually. We have prices started to generate these sort of equal highs or trend line highs just above, which tells us that price would likely go higher before it continues lower. There we go. And it absolutely flew to the take profit, which was a 1 to 9.4 Aristo award. That was an insane trade. That one was actually called in the signals group. If you are interested in that, I'll leave a link to it in the description below. But yeah, thank you guys for watching. If you have any questions about this strategy or any of the entry models, then leave that in the description below. Make sure to like, subscribe, and I will definitely catch you in the next video.